Okay, well, let's get into these pro picks and find some natural gas names. ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, now it's time for some of your high conviction ideas, but because you're a returning guest, we can check up on stocks you made just 3 months ago, so I know that your hold period is longer. Veren was one of the names, and actually it's been so resilient. It's done better than oil, it's done better than TSX Energy sector. You picked it on January 21st, and it's up about 6% since then. Do you continue to have conviction in this name, considering you are kind of weaning back your oil exposure?
Yeah. So Veren got bought by Whitecap, or soon to be bought by Whitecap. They got a Competition Bureau approval, so it'd be in the month of May. We liked Veren because we thought the quality of their assets was being massively mispriced by the market. And I think what we believed was corroborated by Whitecap also seeing that, knowing that the timeline for them to act was shortening. So I do think Whitecap drove the bus in terms of timing. I think it validated our view. We don't own it in the fund today because, again, I just wanted a little bit of cash. But we view the pro forma entity where you're roughly $9 billion market cap, you're bigger, hopefully entice more institutional shareholders to come into your stock to lead to a larger trading multiple, because there's no buyers of small caps today. It's non-existent. You're getting probably an 8.4% dividend, sustainable down to roughly 50 to 52.
This is now for the combined.
Correct. Yeah, pro forma. You're getting paid on a monthly basis as opposed to quarterly. As a Veren shareholder, you're actually getting more. I own it personally for the dividend stream. So yeah, we do like it.
MEG is one people talk about as like maybe a consolidation play as well. That one has been hit a little bit harder, down about 17% since then. What do you do with this?
So it's one of our largest holdings. We only have 12 holdings, real holdings today. So it would be, on public record, it'd be about a 10% weight. It's been sold off on oil weakness and is specifically a Canadian name with max exposure to tariffs, which we haven't really recovered from. We never thought that tariffs would be applied on Canadian energy. It made no sense. There's non-substitutable, highly inflationary, all these different reasons. So I think people sold it on those fears and just haven't come back around to reevaluating it. This would be a name, we hold it because it's got at least 35 years of stay-flat inventory, business model sustainable down to 50, returning all free cash, and over the next 5 years at 60. So where we trade today, they could buy back a third of their stock, and at 70, it'd be about 67 to 70% of their shares to be bought back over the next 5 years.
We spoke with American investor Cole Smeade of Smeade Capital. I don't know if you're familiar with him, but he talked about this idea that it makes no sense for there to be this many energy companies in Canada, and that at 5-10 years, we're looking at, really just a handful because they get bought out, or, they buy back their shares so much that maybe they buy themselves. And MEG, he said it could be one of those plays. Do you think about that?
I've only been doing this since 2003. My ability to time M&A is very challenged. I'd like to hold something where I see a disconnect in value, believing that maybe one day somebody like a Whitecap with Veren, they'll see what I see. But given the sell-off in a lot of these stocks, I don't want to wake up to a 20 or 30% headline premium, because we see very meaningful upside over, a time frame, not in the next month or whatever, but for some of the names that have been referenced, like we could see a doubling or more, we think, in the share price, because again, it's the ongoing theme of what's the value of that last remaining share or those remaining shares after meaningful share buybacks. We think, given we're bullish on oil beyond the near-term uncertainty, that there's meaningful upside in a lot of these names. You just have to be patient and stick with the volatility. Like my analogy today is we're in a storm. It's like your guy in a rowboat, you're out in the ocean and you see this black wall coming at you. Well, there's nothing you can do. You strap yourself in, you ride it out, and your ability to ride out that storm is predicated on knowing what you own and how strong the value proposition is, the strong sort of the balance sheet, the resource depth, that kind of thing.
And does that apply to Athabaska, which was your third pick, down 14%?
Yeah, so publicly it would be viewed as one of our largest holdings as well. We've got a company with at least 50 years of stay-flat inventory. They've got no debt. They have 134 million of net cash on their balance sheet. They're buying back shares with 100% of their free cash flow. Month of March, they bought back 2% of their shares outstanding. You know, at 50, 55, it's basically, they're safe, but it's not exciting. 60 is good. At 70, a name like this really does well.
Now, people might accuse you of being a perma bull in the space, but as you just told us, the way you're adjusting your portfolio, you're raising cash, you're limiting your exposure to oil and gas names, though you maintain positions in some of the ones.
Reducing to oil.
Reducing oil, yeah. But, and then a big chunk now to natural gas, 70% of the portfolio. And names that I see there are Expand, ARC, New Vista. Talk to me about maybe what they have in common and what they, how they can outperform in the sort of the natural gas environment you see playing out.
So our view is natural gas is in now a multi-year bull market because you've had enough increase in demand from LNG to minimize the impact of weather. Like if we have a wickedly cold summer and a hot winter, well, the thesis is challenged. But it's that underlying bid every day of liquefaction of, let's say it's going to be 18 to maybe 20 BCF a day. US is going from 16 to the high 20s. Canada, we're going from 0 to 6 to 8, maybe 8 in the years ahead. And it's then, okay, you see maturity in certain basins. Some areas are bottlenecked from not being able to build pipelines, like in the Marcellus. We think that less shale production growth than the Permian, well, that might mean less natural gas coming out of the Permian as well. So it's, well, where's the marginal basin? And it's the Haynesville, and it happens to be very high cost. We think roughly $5. And that benefit of that marginal cost of the molecule benefits all natural gas companies in North America. And so we want to say, okay, who has the resource depth to have at least 20 plus years to stay flat? Which companies have a market cap size big enough to be relevant to an institutional investor? Because it's helpful to have the institutional investor there because you typically will meaningfully outperform. Who's committing to share buybacks to be able to do that because that buffers your share price in downturns like we're having today. So it's all of those commonalities. In some cases, we get dividends. In other cases, we get meaningful share buybacks. But it's the common thread of multi-year exposure to what should a multi-year bull market for the commodity.
Balance sheets, like we know they're super clean by and large in the energy sector because they got their act together. How would you characterize them in these nat gas plays?
Very, very strong.
All right, well, that's good. Let's end on that concise point. Eric, thanks so much for joining me.